It doesn't matter what strategy you learn, how much time you spend on YouTube learning about Forex and what books you read. If you do not know the time frame that you are planning to trade with and are comfortable with, then to be honest with you, there's not really much success that's going to come from it. And it's one thing that I found out from very early on when I was trading. A lot of people were talking about trading the monthly time frames. That's the true directional bias of the market. If the monthly time frames are trending up, that's where you should buy the markets, or that's what you should do in terms of taking trades, buy the markets. If the weekly time frame's showing that it's trending down and making lower lows and lower highs, then you should sell the market because that's what the institutions are doing. Then things like trade the daily time frame because that's the true direction of the bias. That's what the banks are trading. That's where the key levels are. That's where the institutions have their orders. And for so long, for I would say 2 years, I was on the daily time frame, plotting my key levels at resistance, intermediate levels, and before you knew it, I had 10, 12, 15 levels. Then I scaled down to the lower time frames, like the 15 minutes, the 5 minutes, and I take a trade. And after taking the trade, no matter what pattern was there that I used to read about, engulfing candles, dojis, haramis, whatever you want to call them, I used to take those trades and then find out that even if I put my stop loss above some of the structures or the key levels, price would stop me out. And I used to ask myself, why? Why am I constantly getting stopped out? And it was only till later on down the line did I realize the huge difference between the weekly, monthly, daily, and then your intraday time frames, like the 30-minute, 15-minute, 5-minute, and 1 minute. They correlate because whatever happens on the 1 minute time frame is happening on the weekly time frame, or the monthly time frame, or the yearly time frame. Every single candle from a higher time frame scaling down just breaks down into smaller candles, right? Different structures, but in the same direction. So I thought about it for a very long period of time, and I found out that you cannot, no matter what anybody tells you, I'm telling you now, here first, you cannot be using higher time frames to trade lower time frames if you're intraday trading or you're scalping and think that you're going to find the best confluence just because a key level is solid. It really doesn't work like that. And I remember an example, when I was a lot younger, I got into golf. I think I was about 18, 19, just got married. And one of my escapisms, just to get out, free my mind, do my own thing, was to play golf. Great hobby, I recommend it to every single one of you. And before I started, as you do, you go on YouTube, you do your research, you figure out how to do this and do that, what golf clubs you should buy, etc., etc. But the golf clubs that I wanted to buy were too expensive, or was recommended as the best was too expensive. No matter what forum I went on, the golf clubs that were recommended were too expensive. And eventually I settled for some golf clubs from a sports shop we have in the UK called Sports Direct. And I think I remember getting my paycheck, investing, I think it was about £99 or just below £100, something like that, on these golf clubs. And I was ecstatic. Went, got my membership to a really nice golf course, can't remember the name now, 9-hole, 18-hole driving range, the whole lot. Got on the course with my glove, locked my fingers in, pew, pew, pew. And I just couldn't work out why my golf ball kept going straight and then left and then straight and then right. And then somebody else would come after me or would be before me and they'll drive it off the range or the tee and the ball will go straight. And as you do, when your ball continues to go to this way or that way, or your trading starts to go downhill, you start to do more research and ask questions. So I'd ask the questions and I said to this guy, what golf clubs do you have? And he mentioned a name, can't remember now, and suggested some names. And I was like, oh, okay. Then I asked another person, then I asked another person. And then eventually I was like, the reason why my golf is not improving is because of my golf clubs. So I went, done some research, and I think I come across some golf clubs, Cobra or Galloway or something like that, and I bought another set of golf clubs. Went back onto the golf course, as you do. I know it's not like that, so don't take the P. I know what it's like, but I'm not going to do the full swing now. But the point is, I went back out. The ball went straight, and at the end, darted off to the left, went straight, darted off to the right. I just couldn't, I was just so upset. You know, you spend more money. So then I asked more questions, researched, and then I realized something during my research. It doesn't matter what golf clubs you get or how much you spend on them, more often than not, unless the golf clubs are custom made to your height, to your grip, and the weight of them in terms of the power of your swing, you're not really going to get the full potential out of the set of clubs you've got. What does that mean for you? Well, you're going to ask the question, did I ever get a new set of custom golf clubs? I didn't, no. I was working a 9 to 5, I was very young, I had bills to pay, and I did not have 700 or 800 pounds to buy the cheapest set of custom golf clubs. So unfortunately, I never was able to experience playing golf to potentially the highest standard that maybe I could have been, right? You never know. Anyway, what's the point I'm trying to make? Just because Joe Blogs or George or Bob and his uncle are trading the daily time frame, it doesn't mean that it's going to suit you. You have to ask yourself a few questions and figure out if the time frames you're trading are suited for you or not. You have to ask yourself, does the time frame I want to trade fit my schedule? That's the first question you need to be asking yourself. What's the point in trading a daily or weekly time frame or using those time frames for key levels if you're entering on the 5-minute time frame and the range is 10 times or 20 times larger than is necessary for you to place a stop loss, or if you do place a smaller stop loss, be stopped out by the bigger ranges on the higher time frames. So does your schedule allow you to trade the 5-minute time frame? If it does, then why are you using the daily and the weekly for your key levels? We're going to go into this in a minute in terms of how you should be selecting your time frames, or no, how you should be using your time frames. But that's one of the questions you've got to be asking yourself. Does my schedule allow for me to trade this time frame? If so, then will that work with the strategy I'm using? The next question you really need to be asking yourself is this. Do you cope well with being on the charts for a long period of time? That means that if you plan to trade the 5-minute time frame, you have to understand that your attention to detail is going to be much greater than if you're trading the daily time frame, meaning you're going to have to be on the charts for a longer period of time. But if you're not the type of person that's able to sit on the charts without making up too many stories and wanting to impulsively jump into trades, then in theory, you shouldn't be on the 5-minute time frame. Again, I don't care what your daily or weekly or your 4 hours doing. If you're trading the 5 minutes, you need to ask yourself, can I be sitting there for long periods of time? If so, what time frames do I need in order to help me trade the 5-minute? Well, more often than not, you're going to need a time frame above that to look for behavior and one time frame above that to look for structure. The daily is not going to help you in these instances. Now, a lot of people will say, yes, it does, but I'm telling you now, fact, it doesn't. And I can prove that. And I can also prove you do not need the higher time frames to trade the 5 minutes. So that's another one of the questions you've got to ask yourself. Another one of the questions you've got to ask yourself is, are you mentally stable enough to be able to take a trade and look at the charts? Let's say you're on the 1-minute time frame. You need, again, more attention to detail here. The candles move very quickly, they close very quickly, and are you needing to be at the charts to make sure you can set that trade to break even, trail your stops, or even close your trades early if necessary? But are you stable enough to be at your charts to do that? Or do you need to trade the hourly time frame? If you're trading the 1 minute, the question is this: do you really need the hourly time frame to find confidence on the 1 minute? No, you really don't. And the question is this, or another question you could be asking yourself. I'm just throwing a few questions out here, but you have to think about this yourself because it's personal. Just like my golf clubs, my height, my weight, my strength, my grip is personal to me. You have to figure out these questions and find out the answers yourself. But the last question that I think you really should be asking yourself is this: how much time do you really have to be investing in your trading? Are you the type of person that doesn't mind taking a trade and going about his life? Are you the type of person that just likes to be in and out of the markets and prefers just to sit there for 3 hours? You have to think of those questions and you have to answer them personally yourself. Once you do that, you'll then be able to decide what you need to trade. Now, I'm telling you, if you are trading 1 minute, 5 minute, 15 minute time frames, you do not need the daily, weekly, and monthly time frames. You guys are intraday traders more more so, or more often, or more of you, should I say, are intraday traders. What is swing trading? Does that mean you're a swing trader, so you need to be trading the higher time frames like the monthly and weekly? Not necessarily. You can still swing trade on the 5-minute time frame. So the more important questions are the questions that we've just asked here or mentioned here, and then you need to figure out the rest for yourselves. Now, what I'm going to do for you, because I don't want to just keep waffling on, I'm just going to share a few things with you on the charts for you to have a look at. And then once you go through this, you can then think about it yourself and make your own decisions. And I'll share one example with you, how you can apply this and give you the answer you're looking for. How many time frames do you really need to trade? So let's head over to the charts. So traders, this is the question. How many time frames do you need? Now, we've already discussed there in brief the kind of questions you need to be asking yourself, and trying to figure out what time frames you should be trading. Now, I'm not trying to start a debate here, but what I am telling you is if you're an intraday trader, for the most of you, then your monthly and your weeklies and your dailies are only as good as the time frames you trade below it. Okay? If you're trading off of daily key levels, then you only really need to be scaling down to 4H and 1H. If you're trading off of 1H time frames here, you only really need to be scaling down to maybe 15-minute, 5-minute. Just because you're using the weekly and the monthly and the daily, it doesn't mean your key levels are going to be stronger than, the 4H and the 1H, because you have to understand the candles movements up on the weekly are huge ranges. Let me not try and do this here, but you get the point. No wick, this is the candle. The ranges of the weekly just moving this much creates tremendous trends on the lower time frames. So if you're creating a key level on, let's say, your monthly time frame like this, and price comes to it and you're like, oh, this is a major key level, it's time to sell in the markets now, and you take the sell and the market, and on the weekly the price does this, you could find that on the 1 hour, 30-minute, 15-minute, 5-minute, this candle has just moved a whole trend on the lower time frames, or 30, 40, 50, 60 pips. You get stopped out, and then eventually when the market decides to move down, it moves down, not because you was wrong about the key level, but because you didn't understand the range of the candle's movement on the highest time frames. The same data you can gather from the weekly, you can also gather from the 4H and 1H. Granted, it won't be a single candle, but that's where that's what we'll come on to next. But you get more information, a breakdown of that information that price is failing to break, and then you can plan your trades. Now, if that makes sense to some of you, then you're definitely on your way. But if it doesn't, then hopefully you get it at a later date. But the point is here, what time frame should you trade and what time frames are best for you? That's a personal decision, just like my golf clubs were that I never was able to discover, but that's just life. But we got the answers to the questions. We just was never able to put it into action. But I'm hoping now that I'm telling you this, you can put this into action as a trader. How many time frames do you need? 3 only. You would have heard me speaking about this a lot. Structural time frame, behavioral time frame, and entry time frame. What is your structural time frame for? Your structural time frame is for identifying the structure of the market. In layman's terms, it's a downtrend, uptrend, or range of market. That's it. When you come to your structural time frame, you identify that the trend is down. When you move over to your behavior in your entry time frame, that's the only direction you should be taking a trade. If the market structure is up, making higher highs and higher lows, then when you go down to your behavioral time frame and your entry time frame, you're only taking buys. When the market is moving sideways, guess what? I mean, this is not supposed to be here, but guess what? You're not trading, okay? That's it, you're not trading. So what is your structural time frame for? To plot your key levels, to identify the trend, and just to create a simple plan. Are you buying or selling? Your behavioral time frame is used to identify what the candles are doing. So if you're trading off of the 4H, that's your structural time frame. You then use your hourly time frame to look for behavior. The behavioral time frame is 4 candles of information that you've taken from a single candle on the 4H and broken it down into candle behaviors. Are there lots of wick rejections? Are there doji candles? Is there indecisions? Is there pin bars? Is there momentum candles, etc., etc.? Is price breaking previous structural lows and highs, creating a shift in structure, looking then for potential retest, double tops, double bottoms, etc., etc. That's what you're looking for in your behavioral time frame. Your entry time frame is to monitor for patterns. That is it. Very simple. Identify traffic areas. So if you're taking a buy or a sell, make sure you've got enough range to go break even before you run into problems, and then look for your targets. That's all your entry time frame is for. So if we're using the 4H on the structure, the 1H for behavior, just to break down the 4H candles behavior, looking for those pin bars, engulfing candles, wick rejections, breaks of structures. Your entry time frame is going to be, let's say, the 15-minute time frame. Your entry time frame, you're going to be looking for clear trends, you're going to be looking for breaks of structures, you're going to be looking for your patterns, and that's it. 3 time frames. So how would you work this? Well, if you're trading the daily, the answer is this. You'll be looking for 4H, 1H. If you're trading the 4H, you're going to be using 4H, 1H, 15-minute, 4H, 1H, 30-minute. If you're using the 1H, you're going to use maybe 1H 30-minute, 5-minute, or you're going to use 1H 15-minute, 5-minute. If you're trading the 30-minute time frame for your structural time frame, you're going to be looking at maybe the 15-minute, 5-minute, or 5-minute, 1-minute. If you're trading the 5-minute time frame, I mean, there's not much more to go down from there, but you could be looking at maybe the 1-minute. Okay? So that's how we would work it. I mean, I said 2 time frames there, but you get what I'm trying to illustrate here. So let's take a look at one example of how we would approach this on pound USD. Okay, so now we're on pound USD. What is the first thing that we're looking for here? We're looking for structure. Okay, now looking at this pair and this time frame on the hourly chart, what is the structure of this market? Well, we can see it was in a downtrend. We had a strong gap up indicating bullish sentiment. We had a pullback in this market structure. Price wasn't breaking it, so we're now continuing to identify a bullish sentiment, breaking previous structural highs, making new highs, and then we finally had a break above structure. I think it's very easy to just say, based on the market's behavior and the structure, that we're only looking for buys. Okay, that's it, buys. Now on the hourly time frame, where are we going next? Well, we're going down one more time frame. Let's look at the 15-minute time frame. Now, looking at the 15-minute time frame, we're here on this time frame, and what are we looking for? We are looking for behavior. Okay, now let's make sure we get this a little bit bigger. Okay, we're looking for behavior. Now, what kind of behavior are we looking for? Well, we've already said it. We're looking for wick rejections. We're looking for price to come back into our key levels for retest, and we're looking for the markets to start showing signs of it failing to break below structure or price respecting previous structure levels. So if you can see clearly here, we have really strong bullish sentiment into this key level. In terms of behavior, we have really strong bearish candles, and now we're starting to see a depletion in these bearish candles. Okay, what we want to see from this key level is the price starting to hold. We don't want to see price breaking these structures, and in terms of visualization as part of an uptrend that we're looking to buy, we want to see the market making what? Higher highs and higher lows. We also want to see price come into key levels, and we don't want to see price breaking those key levels, because if the sentiment is up based on our structural time frame, then we don't expect it to break. Rather, respect the level before going up. So now the market is pushing down. We have a pullback into the level that was broken as part of the structural time frame, which is buys, meaning up. Price is holding this level. Once we see price holding this level, what do we want to then do? The example here in terms of behavior is price failing to break structure. Okay, so that's the behavior that we've gathered. Once we gather this behavior, what's our next plan? Well, we said 3 time frames. Let's move on to our final one, which is our entry time frame, and that's going to be on the 5-minute chart here. And a little tip for you guys on TradingView: if you hold Control and then drag it over, you can highlight all of your annotations and press delete. Now, we're on our behavioral time frame. We're not changing our bias. Do not be fazed by what this time frame is doing. We know the structure is buy bias. We know the behavior is price failing to break this structure. Now we're going to look for our patterns. Our patterns as part of an uptrend could be double bottoms. It could be retest, it could be higher low patterns, it could be breakout, break back ins, it could be whatever you want to trade, okay? It's down to you and your strategy. I'm not here to teach you a strategy, I'm here to teach you a principle, and now that's what we're looking for, patterns. Let's go to here and type in patterns, okay? So you look at this three-step process: structure, buys, behavior, price failing to break structure, 3 patterns. Let's continue to press next bar and see what we can find here. So we can see the market starting to push up. What we're looking for the market to do is create some sort of structure we can work with. And at the moment, what we can see here, thinking about it, is we can see the market has just recently broken above this key level. It's created a retest of this level. And now let's say the pattern we're looking for here is a double bottom, okay? That's what we're waiting for, because we didn't get in this trade here, so we're waiting for a double bottom. Now we're just waiting for the price to come back to this key level to show us signs of rejection. Strong bearish candle, and now we have a bullish candle pushing off of this level here. Now when looking at this, some of you might be like, well, I'm not looking to take this trade because there's not enough evidence here. Well, you have to understand one thing, right? Forget about the noise to the left. Forget about what the daily, the monthly, and the weekly is doing. The structure on our structure time frame was buys. The behavior on our behavioral time frame was telling us that the market was failing to break structure. And now on our pattern time frame, it's now telling us we have a double bottom. 3-step process, 3 time frames. These are the structures, these are the time frames I want to trade during my trading day because it fits my schedule and my personality. What do? You take the trade. Now, what am I seeing here? Strong bearish candle into a key level and a bullish candle followed after that. Do I need to look for any more information? Not really, because all the information I've gathered already is from the higher time frames. It doesn't matter how much time has passed. If the momentum is still shifting up and my buy patterns are forming, I'm going to take the trade. So some people might take the trade now. Some people might be waiting for more wick rejections, or some people might be waiting for stronger engulfing candles. Let's say you're waiting for a stronger engulfing candle as part of your plan. You can take this trade again, stop loss below structure, and then again go for your 1-to-3 risk reward ratio trade, something like this. Okay, now once you have this in place, the question is, have you met the criteria of your trading plan? Well, the answer is yes. Structure was on your side, behavior was on your side, and now your pattern's on your side. Does it mean that this trade should win? No. Is there a chance that you could lose 40% of them if you take 100? Definitely. But if you're trading like this consistently, you will be profitable. Allow the numbers to play out and you'll see the numbers start to work in your favor. The point here is this: it's not about winning every trade, it's about approaching every trade with a winning formula. Wow, you just hear that? It's not about winning every trade, it's about approaching every trade with a winning formula. So now, we have somebody who's taking a trade because we have the bullish reaction off of this key level as a double bottom pattern in line with the structure and behavior, or we have somebody who's waiting for an engulfing candle that signifies more of a bullish sentiment along with structure and behavior. You take the trade. Trader number 1 hits his TP. Trader number 2 hits his TP. And that, my friends, is how you trade using 3 time frames: your structural time frame, your behavioral time frame, and your pattern time frames. In terms of the last question, what time frame should I trade? Well, I've given you the formula. It's now down to you to figure the rest out. So there's going to be a lot of you out there that are going to be like, oh, Rockz, you just cherry pick that trade and you just picked the perfect example and blah, 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 blah. Look, the channel is designed to help those that want help. If you can't see the points that I'm trying to make here and you're being a pessimist, then I can't help you. But for those that found this useful, I will mention one thing: not every trade you take is going to win. But if you want to apply this approach to the markets and you want to see if it works for you, make sure you're prepared to invest some time, get on the markets, backtest 100 trades, log them using this approach, and see how you get on. This is a simple price action approach to the markets using 3 time frames, nothing more, nothing less, identifying the structure, seeing what the behavior is based on those candles, breaking them down with a time frame below it or just below it, and then your entry time frame looking for your patterns. Once you keep it simple, you're going to start to see a lot more consistency in your trading. You're going to be able to take away the guesswork, and you're really going to be able to focus on the most important things when it comes to trading. It's not the technical analysis. It's how you maintain this and how you deal with this, your emotions. The more time you can focus your energy on that, you'll be able to deal with losses better. You'll be able to celebrate your wins without getting too overconfident and then blowing it the next day. And you'll start to see that the process in trading is not about what happens now, but what happens in the next 99 trades. So try it out, give it a go, see what you think. Go back, watch this video again, take some notes, and then get into the markets and try to apply it. Let me know what you think in the comments below. If you want to see me do a few more examples like this, I'm more than happy to do so. But as I always say, if you enjoyed the video, make sure you smash that like button for me. Subscribe if you haven't, turn on notifications. And until next time, family, continue to trust the process.